Investors, unemployment is at a 1969 low, inflation's hovering around 4.9%, and the Federal Reserve is turning dovish? Man, oh man, what a time it is to be an investor. If you're new here, I'm Ari, a value and dividend investor on YouTube, here to share economic insights and stock ideas with you so you can enjoy profitable returns on all of your investments, regardless of the state of the market. As for today, we're going to be diving into an account update followed by the economics that you need to understand right now and conclude with 5 beautifully discounted dividend stocks within the SCHD ETF that you can buy right now and just simply hold for both upside potential and massive dividend payouts. Now, investors, enough talking, let's dive right in. So how about we start with a quick account update for those of you who have been following along on my personal journey. After all of the news this past week, my account is now at $112,814.49. That's not quite at the highs of a few weeks ago, but also holding pretty strong as the market wavers. But what's now important for all of us to know is that our portfolios could certainly experience more and more volatility, and in knowing the rationale as to why, it should boost your confidence not to stop investing, but to continue to invest into the long-term value opportunities. And therefore, there are really a few key takeaways to run with, at least at this point in time from the previous 2 weeks. First and foremost, as we know, the Federal Reserve hiked interest rates about 2 weeks ago by 25 basis points. Following that news, the employment report came out and read that the United States added 253,000 jobs to the US economy, whereas we were expecting only 180,000. That means that the labor market remains very robust, while rates are now sitting at the Fed's terminal rate goal of around 5%. And as of the latest inflationary reading, the consumer price index read, inflation is now at 4.9%, down nominally, just as I shared in my last video. But what does that really mean for all of us? Well, as I keep saying video to video, these economic indications point to a recession. And I'm speculating perhaps at the end of 2023, given businesses and consumers will now really be stressed from high interest rates coupled with high inflation. Now, at best, the labor market remaining as strong as it is, well, perhaps we can pull off a rather light recession and at worst a mild one, but nonetheless a recession. So how do we prepare? Well, that prep starts right now, and it's simple. We look to long-term value investments, and that leads me to our 5 dividend stocks that I actually plucked right from the all-famous SCHD ETF. And while some of you may be asking, well, why not just invest into SCHD? You can do so, but there is an added benefit to investing right into individual stocks, and that benefit is simply a greater return. Yet keep in mind, it's certainly riskier. And before I get to these dividend stocks, if you do find value in today's video, any value, do me a massive favor here and tapping on that thumbs up button. And if you want to learn more of the ins and outs of dividend investing, as well as getting stock ideas every single week, then also consider subscribing here. But without further ado, our very first dividend stock of the day, it's none other than Lockheed Martin, ticker symbol LMT, which is a leading American aerospace, arms, defense, and information security technology company with worldwide interest. Now, the vast majority of Lockheed Martin's business is with the U.S. Department of Defense and many U.S. federal government agencies. So if you're really looking to fortify your portfolio, ensuring plenty of safety and reliability, look no further. And just to give you a look into their book of business, their latest deal was secured with the U.S. Air Force and U.S. allies to produce 126 F-35s, which brought in a little over $7.8 billion. Now, there is surely more where that came from, as defense budgeting is always top priority. And in terms of Lockheed itself, this $114.48 billion market capitalized defense behemoth is actually trading down on the year as we speak by almost 5%, whereas it was at a peak of around $500 per share and now roughly $452 per share, with a PE ratio coming in a tad higher than I'd like it to be at 20.6, but should the market uncertainty really shake the market up a bit more, it could come down. But here's why I'm really loving Lockheed as a long-term hold. The government may not be spending much right now, but certainly they will always be spending when it comes to defense. Therefore, analysts haven't lost their optimism either, with the share price rising to $495.08 per share, which is almost 10% worth of upside. And as for smart money, plenty of hedge funds remain bullish on Lockheed as well. Now, we are here for the dividend, and Lockheed will also be able to deliver through with a yield coming in at 2.55%. Next up, let's talk about Texas Instruments, ticker symbol TXN, which is a dominant semiconductor and circuit manufacturer. And while such an investment may seem a bit riskier right about now amidst the ebbing and flowing of consumer supply and demand shifts, I can assure you with an economic recovery, this $147+ billion market capitalized chip player will remain a lucrative investment. And a matter of fact, for what the market conditions are as we speak, it is still performing quite well here, trading for $163 per share, which is up nominally year to date. But on the other hand, the opportunity is still there as well, because that PE ratio is sitting below 20 at 18.4, and looking into the future, analysts are surely optimistic here, with the share price rising to $187.51 per share. That's over 15% worth of upside, to which hedge funds also seem to be beating us all to the punch here, with millions invested already. Heck, and even better news, even a senior vice president here has been bullish on the position, informatively buying more shares. However, as dividend investors invested into Texas Instruments and awaiting this economic recovery I'm speaking of, won't be too bad with Texas Instruments shelling out that dividend at a dividend yield of 2.88%. As for dividend stock number 3, we're going to dive into the healthcare sector as we discuss Amgen, ticker symbol AMGM, which is the world's largest independent biotech company with quite an established history dating back to 1980 and a current presence in approximately 100 countries and regions worldwide. Now, Amgen's medicines have reached millions of people in the fight against serious illnesses such as cancer, cardiovascular diseases, osteoporosis, asthma, arthritis, and many others. And based on our human desire to just simply live longer, healthier lives, we have a gem of a dividend investment here, to which it is also currently discounted as it's down by almost 10% year to date, trading for $234 per share. That's down from its peak of around $279 per share, with a PE ratio at 15.9. Now, I would imagine that with such a reliable investment and fear likely to rattle the market, the discount opportunity won't last long, and we already see plenty of hedge funds investing into this biotech behemoth, along with analysts with buy ratings across the board, with the share price rising to $273.56 per share. That's over 16% worth of upside for shareholders, along with one heck of a dividend to collect on, with Amgen's dividend yield coming in way above the sector average here at a yield of 3.36%. Finally, last but not least, a company that has seen roughly 130% worth of revenue growth over the course of the last decade. We're talking about EOG Resources, ticker symbol EOG, which is an energy company engaged in hydrocarbon exploration and is currently ranked 186 on the Fortune 500 list. Now, fair warning, there's near-term risk given a potential recession, and during recessions, depending on how hard they hit, demand for oil and gas really declines as people consume less, and on top of that, there's just loads of competition out there. But EOG is a great company with solid fundamentals while focusing on really the premium drilling and maintaining a clean balance sheet. Either which way, we do see EOG down on the year right now at $122 per share. That's down by roughly 8%, and I reckon that's really due to the recessionary fears, but catch it at the lower lows and you will profit in due time. And as of this video, EOG's PE ratio is at 7.1, enticing smart money to continue to load up on this energy giant, while analysts also remain very optimistic, with the share price rising to $147.76 per share. That works out to over 31% worth of upside. But here's the best part as of yet: if you're seriously looking to ramp up your dividend returns, EOG is shelling out a hefty dividend with a current yield at 7.83%. And there you have it, investors, the 5 dividend stocks plucked right from the all-famous ETF SCHD that could very well be worth your attention if you're looking to pick up more individual dividend stock positions. Whether it's Lockheed Martin, Texas Instruments, Amgen, Fidelity, or EOG Resources, I'm now curious to know which of these dividend stocks you have in your portfolio, or if you're now planning to invest into any of them, so be sure to drop a comment down below. Now, also remember to tap on that thumbs up button if you found any value in today's video. If you want more stock ideas just like these, then join me by subscribing. With all of that said, investors, I will see you in the next video.